Stellantis, one of the world's largest car manufacturers, just dropped a game-changing announcement, and the stock market is already reacting. Stocks are shifting. Investors are scrambling. But what exactly did Stellantis reveal, and why is Wall Street paying such close attention? Is this the beginning of a massive rally, or a red flag for something bigger on the horizon? Stick around, because in the next few minutes, we're diving into what this could mean for your portfolio, and whether it's time to buy, sell, or brace for impact. In a move that stunned analysts and left investors on edge, Stellantis, the global auto giant behind brands like Jeep, Dodge, Chrysler, Peugeot, and Fiat, issued a surprise announcement that no one saw coming. Within minutes, trading platforms lit up with activity. Headlines began flashing across news tickers, and social media erupted with speculation. Was it a major shift in production strategy? A controversial decision on electric vehicles? A sign of internal trouble? Or perhaps an ambitious power play? Whatever it wasn't ordinary. The timing, the language, and the sheer boldness of the announcement suggested that this wasn't just another corporate update. It was a line in the sand, and the markets knew it. Stellantis stock wobbled, then surged, then dipped again, reacting not only to what was said, but to the uncertainty that hung in the air like a storm cloud. Investors around the globe found themselves asking the same question. What does this mean, and what happens next? For some, it looked like opportunity. For others, it smelled like risk. But everyone agreed on one thing. This wasn't something you could ignore. Because sometimes a single announcement isn't just a company update. It's a warning shot, a beginning, or the first domino to fall. And in this case, it might just reshape the auto industry and the markets as we know them. So, what exactly did Stellantis announce that sent the markets into a tailspin? The answer lies in a carefully worded corporate statement released early in the trading day. And though it may have appeared routine at first glance, it was anything but. The announcement revealed a major strategic pivot by Stellantis, a sweeping restructuring of its global operations, including the consolidation of several manufacturing facilities, a renewed focus on electric vehicle production, and, most notably, the termination of key joint ventures and supply contracts that had long been seen as cornerstones of the company's international growth. Buried within the press release was a stark message. Stellantis plans to aggressively cut costs, streamline operations, and reallocate billions of euros into future technologies, particularly autonomous driving systems and next-generation battery innovation. That sounds progressive on paper, but the market read between the lines. Several long-standing ICE, internal combustion engine, projects were being scrapped. Entire divisions would be realigned. Thousands of jobs were reportedly at risk, especially in European plants, with whispers of major layoffs in Italy and France. And then came the bombshell. Stellantis confirmed its immediate withdrawal from a high-profile EV partnership in China, citing strategic divergence. That alone raised eyebrows. China is the world's largest EV market, and Stellantis pulling out suggested either deep conflict behind the scenes or a new, undisclosed play elsewhere in the world. The reaction was swift. Global news outlets picked up the story, and financial pundits jumped into action, trying to piece together what it all meant. Was this Stellantis signaling retreat? Or was it tightening its grip on a leaner, meaner future? The timing couldn't have been more significant. With the global EV race heating up and competitors like Tesla, BYD, and Volkswagen announcing bold expansions, Stellantis' decision to pull out of key markets and refocus its capital raised suspicions. Were they falling behind or preparing to leapfrog the competition in a way no one expected? And yet, the company's tone remained cryptic. The CEO emphasized discipline, adaptability, and future resilience, but declined to comment on how many jobs would be lost or how long-term partners would be affected. Journalists fired off questions. Analysts speculated furiously, but clarity never fully arrived. What was clear, however, was this: Stellantis had made a choice, a big one, and the world was left to make sense of it. The news, though packed with corporate jargon and hedge language, sent a deeper message to investors who were paying close attention. The company is bracing for something. Whether it's an economic downturn, supply chain chaos, or an incoming wave of regulatory change, Stellantis isn't playing defense. It's going to war with its old identity. And in doing so, it may have triggered the beginning of a seismic shift in the auto sector, one that will ripple through markets, portfolios, and entire economies in the days and weeks ahead. As the Stellantis announcement hit the wires, the market wasted no time responding, and the reaction was anything but subtle. Within the first 15 minutes of trading, Stellantis stock, SDLA, experienced a dramatic spike in volatility. Shares initially surged by nearly 4% as early investors seemed to interpret the company's bold restructuring and pivot to next-gen technologies as a long-term win. But the optimism didn't last. As analysts began to digest the full scope of the announcement, including the exit from China, potential layoffs in Europe, and the risk of alienating key suppliers and labor unions, sentiment began to shift. What started as a rally quickly turned into a roller coaster. By midday, STLA was down over 6%, dragging with it a wave of suppliers and competitors tied to Stellantis production and sales networks. Auto parts manufacturers, battery producers, and even raw material suppliers, many of whom count Stellantis as a major client, saw their stocks dip in sympathy. It wasn't just one company feeling the pressure. The shockwaves were rippling across the entire automotive supply chain. And then, an unexpected twist. Rumors of internal dissent began circulating online, sparked by leaks suggesting that several key executives within Stellantis had opposed the timing of the announcement. Financial blogs and social media accounts with ties to industry insiders hinted at emergency board meetings and tense negotiations that had taken place just days earlier. Whether or not the rumors were true, the uncertainty was enough to stoke further panic. Options traders piled in, betting on heightened volatility in Stellantis stock over the next few weeks. Call and put volumes soared. The stock hit a trading halt, briefly, before resuming with even greater volume, signaling that institutional investors were repositioning fast. Hedge funds dumped shares. Long-term holders trimmed positions. And retail investors? They were left scrambling, unsure whether to buy the dip or get out before things got worse. Meanwhile, Wall Street analysts jumped into the fray with conflicting takes. Some labeled Stellantis' move as a strategic masterstroke, praising the company for cutting fat and investing in future-proof technology. Others, however, warned that the abruptness of the shift, especially the China exit, could indicate deeper issues brewing beneath the surface. Perhaps tensions with regulators, failing joint ventures, or even geopolitical pressures too sensitive to disclose. The broader market didn't escape the fallout either. The auto sector as a whole felt the tremor. Shares of Ford and GM dipped slightly as investors speculated on whether they, too, might be forced to make similar restructuring moves. Tesla stock rose modestly, perhaps on the assumption that one of its biggest rivals was weakening its position. But here's what made the situation even more suspenseful. No one really knew why Stellantis acted now. There was no clear catalyst, no looming deadline, no immediate threat visible from the outside. And that uncertainty injected even more fear into the markets. By the end of the trading day, the Stellantis stock had settled, but not calmly. It closed with heavy volume, large sell orders stacked at key resistance levels, and a dark cloud of uncertainty hanging over the next earnings call. For investors, one thing was crystal clear. This wasn't a one-day story. This was the opening act of something much bigger, and far from over. As the dust began to settle in the hours following Stellantis' surprise announcement, the investment community found itself split into two sharply divided camps, those panicking at the sudden shift and those seeing an opportunity in the chaos. On one side were the bears, investors and analysts who viewed the move as a red flag. To them, the abrupt restructuring wasn't a sign of innovation but desperation. Stellantis pulling out of the world's largest EV market, China, raised alarms. For years, China has been at the heart of every major automaker's electric vehicle strategy. So why now? Why leave just as the market is poised to expand exponentially? Was this a quiet admission of failure? Had Stellantis fallen behind in a race it could no longer win? These skeptics pointed to the vague corporate language in the announcement. Terms like strategic divergence, cost optimization, and realignment, phrases that often serve as corporate camouflage for deeper, unresolved problems. Some feared this could be the beginning of a slow unraveling. One institutional investor was quoted anonymously in a financial publication saying, "When a company exits a high-growth market and slashes legacy programs simultaneously, it usually means something's wrong behind the scenes." There was also concern about what this meant for labor and public perception. Layoffs, factory shutdowns, and market exits. These aren't just numbers in a spreadsheet. They impact communities' investor confidence and government relationships. If labor unions push back, if regulators in Europe apply pressure, or if sentiment around the brand begins to sour, Stellantis could find itself facing more than just market turbulence. It could be entering a full-blown identity crisis. But then, there were the bulls. To a different group of investors, Stellantis' move was nothing short of brilliant. Bold. Ruthless, yes, but calculated. These optimists argued that Stellantis wasn't retreating, it was repositioning. Rather than wasting resources in hyper-competitive markets where it lacked leverage, the company was pulling back to double down on where it could dominate. They saw the cuts as a sign of discipline, not distress. Stellantis, they believed, was shedding its outdated skin to evolve into a more agile, tech-driven force. Supporters also noted that Stellantis had been signaling such a move for months, quietly shifting R&D budgets, hiring software engineers, and forming partnerships with battery and AI firms in Europe and North America. This announcement, to them, was simply the formal declaration of a strategy already in motion. A recalibration, not a collapse. Still, even among the optimists, there was unease. Because whether you viewed this as panic or strategy, one thing was undeniable. The stakes were enormous. Stellantis had effectively wagered its future on a faster, leaner, and more technology-forward vision. That kind of bet doesn't come with room for error. If supply chain disruptions, technological delays, or market miscalculations hit, even slightly, the entire strategy could backfire. And with every tick of the market, investors knew they were dancing on a knife's edge. Perhaps the most telling indicator came not from the retail crowd or even Wall Street, but from the company's own stock buyback activity. There were rumors that Stellantis itself had paused its previously aggressive share repurchase plan just days before the announcement. If true, that wasn't just a coincidence, it was a signal. A company confident in its future usually doubles down when the price dips. The pause hinted at caution, maybe even fear from within. So the question loomed, was Stellantis outsmarting the market or silently bracing for something it hadn't yet revealed? For now, investors are left walking the tightrope between fear and foresight, unsure whether to trust the vision or flee from the unknown. In the world of corporate communication, what isn't said often speaks louder than what is. And Stellantis' announcement was a masterclass in coded language and strategic ambiguity. At face value, the press release appeared polished and composed. The headline touted strategic realignment to strengthen long-term vision, followed by bullet points outlining investments in electrification, global workforce adjustments, and an emphasis on innovation. But for seasoned investors and analysts, it was clear, beneath the surface, the message was far more complex and possibly far more alarming. Take, for instance, the phrasing used to describe the company's withdrawal from China, discontinued operational alignment due to evolving strategic objectives. It sounds neutral, almost benign, but translated into plain speech, it implies a breakdown in partnership, a mismatch of goals, or even regulatory or political interference. Why not say strategic exit or refocusing efforts? The deliberate choice of passive, vague terminology left the door wide open to speculation, and that's exactly what happened. Then there was the mention of enhanced capital discipline and structural cost optimization. On the surface, these seem like healthy financial goals. But in corporate speak, they usually mean cuts, big ones. Not just trimming fat, but possibly amputating limbs. These are the kinds of words that precede layoffs, factory closures, and hard pivots. Yet nowhere in the document did Stellantis quantify how many jobs would be affected, which plants were at risk, or how these changes would impact production targets. That omission alone sparked anxiety across labor unions and regional governments. Even more intriguing were the references to adaptive resilience in response to global volatility and geoeconomic headwinds. These were vague, sweeping terms with no clear explanation. Was Stellantis hinting at tensions with China beyond business logistics? Was there a fear of new tariffs, trade restrictions, or diplomatic instability? The careful avoidance of specifics left analysts wondering whether the company was concealing something it couldn't, or wouldn't, yet say aloud. What also caught attention was the absence of forward guidance. Most major corporate announcements, especially those tied to restructuring or innovation, are paired with revised projections, earnings outlooks, production targets, or at the very least, milestone timelines. Stellantis offered none. No updated EV production numbers. No timeline for plant changes. No revised margins. It was a rare silence, one that begged the question, are they unsure of the outcome themselves? Industry watchers also picked up on a subtle shift in tone compared to past announcements. Normally, Stellantis statements are peppered with confident phrases like market leadership, aggressive expansion, and competitive edge. This time, the tone was measured, even somber in places. The word challenge appeared multiple times, more than usual. And instead of boasting about global dominance, the company leaned heavily into themes of adaptation, efficiency, and survival. Some observers interpreted this as realism, a grounded, humble approach in the face of global uncertainty. But others saw it as a red flag, a sign that the company was preparing shareholders for turbulence ahead, without wanting to spark a full-blown panic. And let's not forget the most glaring absence of all, any mention of competitors. No references to Tesla, Ford, Volkswagen, or BYD. In a landscape where companies constantly benchmark themselves against rivals, Stellantis chose to speak in a vacuum. Was this humility or fear that comparisons wouldn't be favorable? In many ways, this announcement felt like a message aimed more at insiders than the public. A veiled signal to shareholders, employees, and board members that difficult choices have been made, and that even more difficult ones may be coming. The press release didn't clarify, it obfuscated. And in doing so, it left behind a trail of breadcrumbs, leading toward a mystery that's only just beginning to unfold. Because when a company as large as Stellantis speaks in riddles, investors start listening between the lines. And what they hear can change everything. Stellantis may have made the announcement, but the tremors were felt far beyond its own boardroom. As news of the strategic overhaul spread, the automotive industry as a whole began to wobble, like a spiderweb trembling from a single-drop stone. The global auto sector is interconnected, deeply reliant on shared suppliers, competitive benchmarking, and consumer sentiment that can shift with a single headline. And in this case, Stellantis' move lit a match under an already volatile market. Within hours of the announcement, analysts were issuing urgent advisories not just on Stellantis, but on its peers. Ford and General Motors, two American giants that often move in strategic lockstep with Stellantis, saw their stocks dip amid concerns that they, too, might be forced to reassess their EV roadmaps and manufacturing footprints. Investors wondered, if Stellantis is pulling out of China, what's next? Could regulatory pressure, supply chain conflicts, or margin erosion force other automakers to follow? Volkswagen, another key competitor, issued a short statement reiterating its commitment to the Chinese market and long-term EV targets. But the timing felt defensive, almost reactive, as if the German giant wanted to reassure investors that it wasn't backing down just because Stellantis had pivoted. It was a subtle but telling move, underscoring how one company's decision had instantly become an industry-wide conversation. Meanwhile, Tesla, ever the disruptor, saw a modest bump in its stock price. Not because it was directly involved, but because investors began to speculate that Stellantis' exit from certain markets might reduce competitive pressure, giving Tesla more breathing room to increase market share. Elon Musk didn't comment publicly, but Tesla watchers on social media pounced on the opportunity, spinning the narrative. Legacy automakers are blinking. Tesla keeps pushing forward. The supply chain, too, felt the ripple. Lithium and cobalt suppliers with contracts tied to Stellantis battery plants saw their shares drop, while third-party EV tech startups rumored to be working with the company entered a news vacuum. No confirmation, no denial, just silence. For small-cap companies that live and die by partnerships with giants, that kind of uncertainty is deadly. More importantly, Stellantis' move called into question the very pace and sustainability of the global transition to electric vehicles. For years, governments, investors, and climate advocates have been betting on a rapid, near-linear shift from internal combustion to electric. But now, here was a major automaker saying, implicitly if not explicitly, that parts of that roadmap were no longer viable. That perhaps the economics didn't add up. That maybe EV adoption in certain regions wasn't moving fast enough to justify current investments. That doubt echoed through policymaking circles. European regulators, already grappling with energy crises and cost-of-living concerns, began facing new questions from media and constituents. If Stellantis is scaling back, are our EV mandates too aggressive? Even environmental groups, usually unified in their message, expressed concern that market volatility could slow down the very transformation they've been pushing for decades. In Japan and South Korea, legacy brands like Toyota, Honda, and Hyundai quietly reevaluated their own exposure to the Chinese EV market. None made immediate changes, but insiders reported a spike in internal strategy meetings. Stellantis' decision didn't cause a mass exodus, but it created hesitation. And in a race as tight as the EV revolution, even a moment's pause can change who wins. The labor markets were shaken, too. Unions in France and Italy, both heavily dependent on Stellantis factories, called emergency meetings. Strikes were hinted at. Government ministers demanded answers. If one multinational automaker could reshape its future overnight, what protections were in place for the workers who would be left behind? And all of this unfolded in just a matter of hours. This wasn't just a Stellantis story anymore. It was a moment of truth for the entire automotive industry, an inflection point that forced competitors, suppliers, governments, and investors to look at their own strategies and ask a very uncomfortable question. What if the future we've all been preparing for isn't going to arrive the way we thought? So, what started as a single corporate announcement has now unraveled into something far greater. A wave of uncertainty crashing through global markets, boardrooms, factories, and even the halls of government. Stellantis didn't just make a business move. It fired the starting gun on a possible reset of the auto industry's future. Is this the beginning of a bold new chapter for Stellantis, or the first crack in the foundation of a crumbling EV dream? Are they a visionary, cutting through the noise to forge a smarter path, or a canary in the coal mine warning us all of a slowdown ahead? One thing is clear. The decisions made today won't just shape quarterly earnings. They'll define the next decade of mobility, technology, and geopolitics. And as the story continues to unfold, you can bet this won't be the last shockwave. Subscribe for deeper dives, exclusive market insights, and real-time updates as the Stellantis story develops. Like this video if you believe this is bigger than just one company. And let us know in the comments, was this a smart pivot or a panic play? Because the road ahead, it's anything but smooth. Stay curious, stay informed, and most of all, stay ready.